Hey folks, welcome to today's webinar, 5 Essentials Every Leader Should Understand About Credit Automation. Super excited that you guys are able to join. We've got a large number of attendees, so we're going to try to make this as substantive and meaningful as possible. I'd like to start by introducing our panelists. Really excited about the mix of people participating today. I'll start with Adam White, Director of Commercial Risk Solutions at Equifax. Really want to thank Equifax PayNet for their partnership on this webinar. Adam, we went back a couple months ago talking about doing this, and we shot around a couple ideas, and we really thought that the contents of what we ended up with would really kind of help people the most. So thank you for you and your company's support on this. You've got some great data and excited to share it with everybody.
Yeah, thanks for having us.
We've got David Trost with Nortech. So David has a varied background. He's worked at banks, he's worked at portfolio services companies, he's worked at fintech, and now he's leading product over here at Nortech. So he's got a really varied background and can look at the topic from multiple angles and from a technical perspective. So David, super excited to have you part of the panel.
Yeah, me too.
All right, so there's me. I'm just going to be asking questions. I'm CEO, founder here at Nortech. Um, Next, we've got Dan Thompson, who is a risk leader at Capitus Equipment Finance. Super excited to have Dan. Dan and I have been working together, gosh, probably about 10 years now, Dan, maybe more like 12,
Mm-hmm.
12 or 15. But we go way back. Dan has a varied background in credit automation. Spent a lot of time at Midland Bank running the credit group over there at Midland Bank Equipment Finance, and is now running the risk over there at Capitus, independent. So Dan's coming at it from a long-term, bank perspective, but also an independent. So he brings a great variety of thought to the topic. So Dan, good to see you. Thanks for joining.
Glad to be here. Thanks, Christian.
Okay, Nate. Nate's been a client for several years as well, probably five or so, Nate,
Yeah.
So he's the CEO over there at Director of Operations at Geneva Capital, an independent here in Minnesota. Nate's got such a varied background. He knows credit backwards and forwards, but he also is able to balance, the needs for credit along with creating an amazing vendor experience and engaging with sales. So he's going to come at things from a unique perspective as well. So Nate, great to see you. Thank you so much for your time today.
Thanks for having me.
Awesome. Well, hey, let's get started. So, like why is this important today? So borrowers and vendors are demanding in many cases in many industries faster approvals. In some cases, we've gone from going from hours to minutes down to seconds. Automation is advancing. There's new data sources, there's AI, there's smarter scorecards. All that needs to be considered when you're coming up with an automated credit strategy. This webinar is going to focus on 5 essentials every leader should understand when building and refining a credit automation strategy. Note that I didn't say credit scoring or credit scorecard. That's only a component of it. This is really, and we'll talk about it. We'll get into like very specific, so don't worry. But we're really going to take a step back and also look at just what is your credit strategy? What's your go-to-market strategy? So with that said, I'm super excited to explore these essentials. So let's start with number one. Defining your credit strategy. So, as I mentioned, like with Dan and Nate, and even David when he came from a large bank, everybody's coming at this from different perspectives, and your strategy has to be different. There is not one size fits all when it comes to, finding the balance between speed, balancing risk. A bank might win instantly by approving A credits. My guess is that's not going to work for Geneva. An independent finance company might still require speed, but they might have to find more creative ways to look at those B credits and see how it might work. And you also have to really find balancing the need for rapid decisions with having effective risk controls. So that's setting the stage for essential number one. We're gonna take a step back and look at some data. I'm gonna pass it over to Adam to walk us through this slide.
Yeah, thanks a lot, Christian. And I totally agree. One size does not fit all when you're actually trying to build out and analyze that population when you're developing that credit automation strategy. On the screen, you can see that kind of in practice here. What I'm showing is consumer scores by credit quality, the delinquency of the portfolio. And as you can see, the overall in the dark blue or black bars is showing right around the mid 1% range. But as you can see, the prime, that Vantage score between 660 and 780 has a delinquency, a very low delinquency of about 0.25% or 0.2% going back. But that really is much different when you look at that population between 600 and 660 roughly in that orange bar. That's well over 2 to 3%. So, when you're trying to build out your strategy, you really need to understand the segments that you're building. And they may have a much different strategy between the different segments or the different populations. So if you think about, equipment finance, we do see a lot of equipment finance lenders getting into working capital or inventory finance, sometimes owner operator transportation. You really need to understand your population when you're defining that definition of default, so to say, and really trying to figure out that outcome or that goal for that credit automation strategy. For equipment finance, the definition of default typically is 90 days past due in a 2-year period. I would say for working capital, you're looking much shorter. Maybe it's 60 days past due in a 1-year horizon. So can widely vary, and I know others on the panel here have experienced this just in their everyday practice, but this is something that you have to really take into consideration.
Great. Thanks, Adam. So, kind of like taking a step back, looking at strategy. Dan, you've got a varied background. So worked at a bank for a number of years in their equipment finance division. Now you're at kind of a fintech, right? Capitus and Independent. Tell me, can you talk to me about like what were your key strategies, maybe over there at the bank,
Sure.
maybe at Capitus?
Yeah, I mean, so it starts with kind of for me defining your risk appetite. Where do you want to live? Relative to, and that is a waterfall of events that happens from that. So what is your sales strategy? What are you pursuing? We say a lot, essential use revenue generating equipment. And that doesn't have to be hard assets anymore. When I started, it was always just kind of a hard asset. That's what you went. But, that essential use revenue generating. And then you determine, again, your risk appetite from there. What do you want that borrower to look like? I mean, everybody can, I think, generally speaking, easily identify that a customer, but it's the B's and C's where people start to have different takes on it. And then it is, can you make a C a B, or do you just better protect yourself on a C? So in other words, it's always going to be a C credit, but you put in some rules around how to approve a C. Those are the kinds of things. And then, at a bank, not surprisingly, they look for credit quality as one of the key drivers. So, especially for a public institution where you're reporting delinquency and charge-offs and so forth. Here at Capitus in the independent world, your credit quality is definitely important, but there is the flexibility to do things that we couldn't have done at a bank, in terms of listen to the story credit and understand that again, you don't necessarily have to do something that makes a C a B, but you just have to understand what is the risk associated with approving a C, and then that leads into rate. And I know we're going to get to that later, but so I'll just pause right there with those comments.
Cool. Thanks, Dan. Hey, Nate, so you've been at Geneva a number of years. You're always probably going up against the banks, on deals and whatnot. Tell me about your strategy. Like how do you guys look at this?
Yeah, you hit the nail on the head there. And I think you have to start bigger picture than just credit strategy. And what is your business strategy? What is your go-to market? And then how does your credit strategy fit into that? And what I mean by that is, are you shooting for the online shopping experience where it's truly touchless? The customer is just clicking through everything without interacting with
Mhm.
human intervention. Or for us at Geneva, we believe one of our differentiating factors is our people. We want our people in that process at certain steps. And so we don't want to automate everything. We call
Mm.
it assisted automation, automate the things that can be faster, but without losing your differentiation, which in our case is the people. So I think that's important when we talk about strategy. It's knowing who you are. And then Dan touched on, knowing your markets and defining your risk appetite. And I would phrase it in a way that I would say, not all defaults are created equal. And so if you got your scoring model tuned, it's going to predict your likelihood of default. Great. But a default on a hard collateral asset versus a default on a soft collateral asset
Mhm.
is going to have a very different result on your profit and loss statement at the end of the day. And so that's where you got to start layering on things outside of the scoring model to develop those business rules that Dan talked about, to say, we're going to do this with a score of X and a vendor of gold rating and a collateral classification of medium. It's
Mhm.
all these if-then paths that you have to go down in defining the strategy beyond just the scoring model.
Mhm. Yeah.
Yeah, I
Well,
think
well, great.
Nate makes a good point there around starting out with that human intervention. You can build out those rule sets and those strategies and master that quality process before you automate each piece of the the strategy. So it can be it can then be automated more and more down the road as you develop that quality, touchless process.
Right. Like one thing that Nate said too that really resonates is like, hey, this is yeah, credit is part of the strategy, but it's an overall business strategy. So I just like to go there for a bit. So and maybe I'll take it more granular and then I'll take a step back. But like t tell me about pricing. Like how does your pricing strategy um get affected by your credit model? And I'll leave it with kind of a quote that I heard from a colleague in the industry that recently it was an independent that got acquired by a bank, and he was kind of venting, but he's like, the bank wants me to sell. He wants me to sell C pricing to A credits. I'll leave it at that.
Don't we all? Yeah. No, and the risk-based pricing is what we all have to do. It's getting tougher and could potentially get tougher with 1071 if that ever becomes a thing, and regulations and how much flexibility you can have on pricing. But that's where a good model can actually be your backbone, because that's what regulators are looking for, is that you're not putting all the flexibility into your sales reps or your dealers or who's ever actually doing setting the pricing. Um, a good model and good automation is your evidence that you have systematically set pricing, and not just discriminatory based on who the person is sitting across the desk from you.
Right.
Yeah, Christian, I'll jump in there real quick to echo those comments and go back to some of my first ones. But so Capitus is been in business, coming up on 20 years, and primary product is working capital. And so I'm very green on that, but I've learned a lot about it in a certain time. But the one thing that has translated over to equipment finance is we're willing to accept risk so long as we're paid for it. So it goes back to, again, identifying, I'll just keep using A, B, and C as kind of the generic terms because I think those resonate. But again, I don't think you want to do something that says a C is now a B because you could be depriving yourself of what the proper pricing is on that credit. You can protect yourself on a C credit by money down, additional collateral. But I don't think you want to go, at least me personally, I don't think you want to say, hey, because we got money down, this is now a B. The metrics are the metrics. And then what you could do, again, consistent with how Capitus looks at it is, look, we'll do the Cs, but this is what we expect in return for them. And if you decide to say that, hey, we took a C and we made it a B, I think over time, through performance, they can become Bs. A B can become an A and so forth. But when you're in the moment, I think you have to look at it and go, look, the risk says X, and this is the return that we expect for that type of risk.
Yeah. Well, fantastic dialogue. We're going to move on just because of the sake of time, but it sounds like there's a number of levers, and it sounds like just overall what I'm hearing is be deliberate about what levers you're pulling and what market you're going into. All right. So next is going into building the right scoring model. Okay. So, like a lot of what we hear, like when we go to our clients, they like to start with the low hanging fruit, right? Identify the deals that just can be, quite frankly, auto declined, right? Let's not waste people's time. Let's just auto decline them or auto syndicated in some cases as well, or be auto approved. You do need to build scorecards that are unique per product, unique per equipment type, unique per geography. Not saying everyone needs to be unique, but you need to take these factors into consideration, and then also understand what third-party data providers you have, like Equifax, Consumer Reports, PayNet reports, things like that, that you can incorporate into your score. So with that said, we're going to go over a couple slides. Adam's going to walk us through a couple considerations when you're building your scoring model.
Yeah, and I think understanding that you really do want to make sure that you're working with a score or a model that works through different economic cycles before you get into that automation. Nate mentioned it's the backbone of what you're trying to do, and that couldn't be any truer. This slide here shows the PayNet Master Score going back to 2003 with default rates. And the PayNet Master Score predicts whether a business is going to go 90 days past due within a 2-year period. And the score tiers, which are listed, shown on the left-hand side on that x-axis, with default rates, in the different colors, as you can see from the worst at the top going down into the green at the best scores. And no matter what year, if you move forward, Christian, there, I highlighted 2 years here, 2008 and 2021, two really kind of strange years, I guess, when you look at historic economic cycles. But the score actually rank ordered risk no matter what year you're looking at here. So the weaker scores had higher default rates, all the way down to the better scores with lower default rates, so that you can then set your cutoffs and your automation parameters around a score that is effective, and that can lead to your efficiency gains. However, you do need to make sure you're tracking this score through different periods. So as you can see there, highlighted 2021 to 2022, those default rates for a 660 to 679 score doubled. And so that's where that management of that score comes in. It's still rank ordered risk, but you still want to be on top of your score. Maybe you need to shift, and as you move forward with the slide here, you may need to shift your cutoffs or build a rule to make sure that you are in line with what's happening in the economy to keep your approval rates, your risk cost rates at an even level. So we just wanted to highlight that. However, on this slide here, now I'm showing the same exact metrics, but with bad rates at 12 months. You can get ahead of your loss curve, so to say, and make sure you're proactive by looking at a quicker horizon. So you can still see that there are doubling of default rates in that 2021 to 2022 period. You may, that causes your credit department to get a little more conservative, maybe in the 2023 time period. So you really have to be on top of these metrics as you're managing your score.
Awesome. Well, that's great. So, hey, Nate, outside of the master score, what are some of the data points that you find most predictive in the default of your portfolio?
Yeah, so you mentioned one, and this circles back to defining your strategy and Dan's mentioned, envisioning what your customer looks like. So here at Geneva, we do a lot of very small businesses. We have a significant portion of our business is startups where they don't have any PayNet report. And you can see on Adam's slide, no score is accounted for. You can get a certain level of predictability there. But obviously you can enhance that with layering on other factors. And so when we're talking about those small borrowers, new borrowers, consumer credit plays a heavy part of our model. And being predicted, especially starting off, the way a person manages their business is the way they manage their own finances. So that's extremely helpful for us. And then through the rule sets, we can say, in these instances, we need to layer on additional information. Maybe we're talking banking data, or at certain dollar amounts, financial data. But those are more exceptions than in the model themselves. So consumer is the big piece that we add in on top of the PayNet. And that's largely based on our customer base. Now, if you're doing minimum time in business of 7 years and $200,000 transactions with established borrowing histories, PayNet alone might be very well predictive for you, and you don't need to bog down your model and your overhead by adding in those factors. But for us, it's necessary.
Great. David, what are you seeing like with your clients out in the industry? What other predictive components do you see that could affect your scorecard?
Kind of business is the big one, honestly. But I think what we're seeing more of is it's a lot easier now to create scoring models. So more data is being pumped into these models, which results in more variables and more complex scoring systems. And so clients are trying to figure out how to take that complex score and be able to translate that to vendors and third-party originators so that they know what deals fit their box. And that could be the top 5 variables or the things that are most impactful on that score. But trend is on the flip side of that is keeping that complex model in place and making it easier for someone to get pre-qualified or pricing with minimal amount of information required. So you have really high confidence that if a deal is going to go through, someone can see what pricing is and if they fit your scorecard or not, while still keeping your risk tolerance and factors in place as far upfront as possible in the process.
Great. So Dan, like within your organization itself, is there a one size fit all? Do you just like build one scorecard and you're done, or do scoring models kind of vary based on a lease versus a loan or different equipment types, or quite frankly, where you lend?
Sure. So I'll speak to that from a historic perspective as we're still building what we're going to do at Capitus. But for the prior 2 stops where I was at, we had one scorecard, with the key data points, time in business and master score and FICO and so forth. And then we overlaid what I'll call business rules, the different attributes that, were more along the lines, not character driven per se, but like the easy one that I always go to because it's relatable is, especially at a bank, if they were on the OFAC list, then it kicked out. Like you couldn't approve it under that scenario. But we would do different things related to certain industries. So we were gun shy around forestry equipment. So we would have different business rules around that, and it might relate to age of the equipment, the region in which they were buying the equipment or operating, different things like that. I think everybody's got a lot of PTSD from trucking, and whether or not you needed a different scorecard or if you just needed stronger business rules. At Midland, we looked a lot. We made a lot of changes with trucking multiple times, even before the full-on recession hit. And it was for a variety of reasons. One was bank concentration limits. And we found we could drive volume up or down more so with business rules than just changing, hey, let's just raise our master score and just make that the cut. So we implemented a lot of different attributes. Nate and I shared some comments right before this about his approach on that stuff too. And I think that that's really important to look beyond just the data points, but what do you want the overall customer to look like beyond scores? And I think it's important. So now that said, I'm sure there's plenty of reasons to have, multiple. One thing they'd be curious about from the group, Nate touched on, you're right, a hard asset is generally going to give you back a certain return. But if it's softer IT equipment, your P&L could look a lot different if you're taking losses on that. So do you want an LGD component to your scorecard? That might be something that you would do differently with a softer asset.
Can you explain that, Dan? What is an LGD?
The loss given default on the asset. So in other words, if you get a truck back and your LGD is 50%, you expect to write off 50% of what the value is at the time you're getting it back. And that can go up or down. Unfortunately, trucking, is a great representation of this when for a couple of reasons. Shortly after the pandemic took hold, values of trucks went through the roof because chips and chassis were hard to come by, and if you had a truck, you could buy it and resell it for more than what it was worth. And then 18 months later, it was flooded. And as the market saturated and trucks came back, your LGD rose significantly. And what you were getting back was, 30 cents on the dollar, 20 cents, stuff like that.
Oh, great. One thing, like kind of going back to what you said about concentration, I've got kind of like two-part question here. I'd like you to unpack that a little bit more, or anybody on the panel, but also like to talk, maybe David could weigh in on data, because my guess is like, how do you even know, like, do you even have the data to figure out what your concentration is, and what are some of those key data points to make sure you're capturing so you can measure that?
I hope you do. Um,
Okay, next question.
so I think what Dan made some interesting points about like these like the micro market. So a trend that I've seen is not necessarily that there's this magic new data point that's available that can change how people are underwriting, right? There's no like if you get cell phone payment history, it's not going to be like magically indicative of whether or not someone's going to pay you back or not and completely overhaul your credit model. But um, it's a lot easier to enrich data now with different data sources. So knowing what the business actually is, where they're operating, like if there are things happening on a county level and you have enough history there in your portfolio to actually slice your scorecard into even further subsections based on if it's regional trucking versus long haul trucking, or regional trucking in the Northeast versus in the Southwest or Southeast. And so your concentrations go from the traditional industries that we all see reports and trends on, which Adam has in a couple slides, to something that is specific to your portfolio performance.
Great. Okay, well, let's move on to the next essential. So essential number 3, test, learn, and iterate. So you've got to treat your scoring model as an evolving model. You've got to use feedback and performance data to make incremental improvements. Automation is not a single switch on and let it go. It's more of a gradual, ongoing process. We're going to be talking about over the next few minutes, shadow scoring, side-by-side testing, phased rollouts to measure accuracy and redefine rules before you flip on the switch and just start approving or even declining a bunch of deals. But like the other essentials, let's start with some data.
Yeah. So this slide here is showing historic default rates by industry, as well as forecasted default rates by industry. And I guess this goes back to 2019. This is a good way to actually benchmark against the different industries and how well your portfolio is performing against these different metrics here. One of the big ways to validate your scorecard is to do a retro analysis. Look at your different populations. We can go back in time and score them with I know at Equifax we can score any of our scores back in time and validate whether a score is working on your population before you actually move forward. And then one of the other things that can be done in order to test out a population set, and before you actually go into a live scenario of automation, is what we call a swap set analysis. So being able to actually look, even you could do this by industry or by different segments, look at your population and see maybe there are applications that were approved in the past that now today the model is saying, oh, you should decline that, or vice versa. It was declined in the past, and now the new model or the new score is saying, oh, you should approve that, and actually go through those and look for common themes. You could actually build rules off of that. I know Dan's talked about building rule sets. As you go through those themes, you can actually see in the swap set ways to, cover yourself so that when you go into that live environment of automation, you're not actually taking any more risk. You're able to screen those applications out to analysts. So I think that's a few ways through benchmarking of these default rates here. Historic retro analyses is a great way, and I think that can be done also ongoing on an annual basis.
Awesome. Thanks, Adam. All right. Well, maybe to start out with, kind of like getting to some specifics. Dan, like based on your experience, whether, obviously you're starting a new portfolio at Capitus, but your other two stints, banks, and, what are some of the metrics, approval accuracy, default rates, what metrics really indicate that your model is ready? You and I put together scorecards in the past, when we worked together. At what point did you turn those on? When did you feel comfortable turning those on?
Sure. So I'll go back at this point, 3 companies. And we did a retro with Adam and team. And, we were operating kind of under the subject matter expert, decision, where you had guidelines and you had every analyst just looking at a deal and following the guidelines and deciding to make it or not. And so we did the retro, and they took our guidelines, and I think we ran like 7,000 contracts through it, good, bad, indifferent, declines, withdrawn, and all that stuff. And we really kind of focused. So there was a population like Adam was talking about, everything that we approved that their retro said you should have approved, everything that we declined that their retro said we should have declined. And we kind of focused on the outliers. What did we decline that they approved, and what did we approve that they would have declined? And we kind of focused on that to try to determine what was the difference, and why would it look so different, not and ultimately what we did is we ran parallel, with the idea that the card really was meant to drive behavior. So if you have 2 analysts, whether they're sitting side by side or across the country from each other, they look at the same deal, the card prints out a result, you've got your business rules, and it's not an easy decline, it's not an easy approval, that they come to the same decision independent of each other. And that was one of the things we did. But we just ran parallel for a while. I think it's important. So you ride the horse that got you there, but then you disrupt it with this new process and see how much disruption is it causing, and is it good disruption? And that's really what you're going for in that scenario. But at some point in time, you tweak it. We talked a lot about when we were building it, do we want to, and what we ended up doing was we said, hey, we want a 75% approval ratio. So what do we need to tweak with this results to get to 75% approval ratio? And then we threw in different factors like, is a corp only deal where you're not getting PGs, should that score the same as a deal with PGs? Should a corp only deal get your highest possible score, or do PGs naturally, it was those kinds of factors that we looked at to kind of drive it. But we reverse engineered it from the perspective of, we wanted an approval ratio of X. And then that's what we drove towards.
Now, I would imagine you could use some of the data that Adam presented to then fast forward and say, based on predictive default rates, here's what we should anticipate
Correct.
with that approval ratio.
Correct.
Wow, fascinating. Hey, Nate, Dan talked a little bit about, like, disrupting the current process. Is there a way to avoid that?
I think it depends on your organization. In reality, probably not. Testing is painful. You can do a certain level of testing via automation, and the retro analysis is key there. It's working with your service providers, make sure you have good vintage data, apply it to your past applications, and you can see exactly what the model would have done. But there's the concept of overfitting. If you have just your data going in there, hey, it performed great on that historical, but what does it do with new data? And that's, again, this part of it can be automated. If you're looking at enhancing and bringing on a new service provider, they should be giving you that vintage data as well to put into the model and see how it performs. But when you want to see, especially if it's your first time implementing automation, what it's going to work like, there's no substitute for doing the side-by-side comparison
Mhm.
and seeing how your analysts are going to result with that.
Mm.
For us, it meant taking down barriers. We have a very limited project management staff anyways, but it's not requiring the analysts to work through project management to data scientists and IT professionals that are implementing the model. It's saying, okay, you guys built the model. We agree it's statistically valid, but that rule set is missing this, this, and this. This is not how I would actually approve a deal. And organizationally, we agree with how the analysts would actually approve the deal. So
Yeah.
now it's that development cycle between the analysts back to our IT folks to account for those business rules and say, okay, that we missed this. We got to go back again. And it's hard to put a definitive line in the sand of a measure that you talked about. When do you switch the automation on? It's when those change requests just naturally start coming down to be rare enough that you're okay with it.
Yeah. Yeah. I guess, like one thing I just thought about, we didn't talk about it previously, is how do you avoid biases, Nate? Because I would just imagine if I'm a younger credit analyst, I'm not super confident, like when I just go with the score, like how do you keep somebody from just like rolling with whatever the system's telling me?
Yeah, and that's where we approached it. It sounds like very similar to the way Dan did too, is we built the model to replicate what the humans were doing, not the other way around.
Mm.
Um, and so then for your newer analyst, they've got that trust. If we did it right, well, this is the teaching. The model is the teacher now. It
Okay.
replaces what the human used to do.
And I
Got it.
think the scoring model is really the, call it the science. It's crunching all the numbers, it's giving you that recommendation, but then the policy is where you bring in that, call it the art of the whole thing, and you can put your experience onto that automation. So you're keeping the flow going, but you're only filtering out what matches into your credit policy and what you want the analyst to kind of review.
Mhm.
Yeah. So like one thing about this topic, and there's probably not one right answer, and maybe this is more of like factors, but like talk to me about like how often should you be revisiting and recalibrating? I mean, Adam talked about all this macroeconomic stuff. Dan talked about concentration levels. Nate, you've talked about different scoring parameters and whatnot. How often are you reviewing your model and iterating on it?
Yeah, from a monitoring standpoint, I would recommend it quarterly at a minimum. If we do a monthly comparison, and we have some talks about benchmarking coming up here, um, you just need to know what's going on with it. Iterating, I would be much less for. And again, I don't have a hard line in the sand to say when you iterate, but I would be very disciplined there, because if you are constantly shifting your model, you
Mm,
don't have a comparison over time. You want to have a real strong reason before you make a change in the model, but stay on top of it on a regular basis so that, hey, we've seen this trend for 1 month, we've seen this trend for 2 months, it's missing 3 months, 4 months. Okay, we've got a pattern here. We need to adjust something.
yeah,
But be disciplined there. Don't be constantly changing the model. You're going to have no historical sense to it.
great, great point.
I think it really depends on how big your data set is and how many deals you're actually funding in a given period of time. So you have enough deals on the books to actually get a trend going. And this goes back to what Adam was talking about versus the policy versus being the art versus the actual scorecard being the science. So you can be a small lender and doing, 100, 500 deals in the books in a quarter and still adjust your policy while maintaining your scorecard to make sure it's performing effectively and change the deals that you're seeing. Where if you're doing, 1,000+ deals a quarter, you're going to have a lot more flexibility and actually seeing how your scorecard performs in a shorter amount of time.
Hmm. All right. Let's go to essential number 4, review cycles and market responsiveness. So kind of like the gist of what was just said, it's not just a set it and forget it. There's economic trends. I think Dan was talking a lot about transportation. There's weird stuff that happens like COVID, where there's a lot of capital that's thrown into the market. And so these things require regular recalibration of thresholds and weightings. A well-run review cycle does ensure your credit decisions remain well aligned with your risk appetite and the market realities. So let's dive into this topic a little bit, and let's start with some data. Adam.
Yeah, so when you're reviewing obviously your scorecard, that scorecard management has to be ongoing. I mean, on a daily basis, monthly reports, things like that, and being in tune with what's happening in the market. One of the reports we put out there is called our SBLI, Small Business Lending Indicator, and it really tracks the amount of leases and loans being booked out in the market. And as you can see on this screen here, we're showing by industry the year-over-year change and the month-over-month change. Some industries from a year-over-year perspective really took a little bit of a downturn, but month-over-month they're starting to stabilize and normalize. And I think benchmarking these against what you're seeing in your app volume coming through the door, and then what app quality you're getting as well, can be a big like a barometer as to what's happening in the market. Because as these markets start to downturn, the app quality can get a little more questionable, and you may want to look to obviously alert your credit teams about what the approval rates are looking like, especially with certain industries that are struggling, which leads to the next slide, where you are not only looking at what's being lent out in the market, but what delinquency levels. And this is showing the early stage delinquency by the 6 major industries. I know it's hard to see the actual industries. The one at the top there, the blue one, the transportation, obviously was the one that was being talked about here a lot over the last couple of years. But you can see an uptick in just about each industry here over the last couple of months. So just being in tune with where the delinquency is going as part of your scorecard management, this really does change the scores that are coming through in your model. I know at PayNet, we are adding this data into our scores, which then feed the models being put out in the market by the lenders. And you want to make sure you're comparing your decisions that are being recommended by the model with what the analyst is decisioning as well. So that is really a good feel for how your analysts are following the model and making sure they're in tune with the industry.
Yeah, super interesting data, right? Like like when you talk about like the transportation, post-COVID, when we were just going hog wild with Amazon, right? Like those were good times, and good times for equipment finance lessors. So with that said, you're stuck on this webinar with a bunch of old timers that have a lot of battle wounds, and I'm gonna ask Nate to share some of his. Tell me, Nate, like tell me some stories about when times are great, and you guys are making money hand over fist, and then things change. You have any words of wisdom there?
The one word I'll go back to again is discipline. We talked about it in the not adjusting the model, being disciplined to trust what you built and stay with it. And it's hard to do. We all feel it on the credit side. You've got sales breathing down your neck of we need to approve more deals. And hey, yeah, from 2010-ish, 11 to 2020, things were great. We were on one of the longest expansionary cycles in history, but you got to remind those people that came into the industry during those 10 years. We also
Mm,
had 2008.
mm,
And we know that times aren't going to be good forever. And we saw that coming out of COVID when that money dried up in 2022 as well. Is if we had gone hog wild, yeah, we would have maybe gained some market share in 2019, but we also would have taken a lot more losses in 2022. So it's leaning on history. Know that history always does repeat itself. And that's where this benchmarking can come in super helpful is you've got these industry comparisons, but draw your own line for your own company and lay it right on that chart and see how do you move with the market. And
mm,
that helps take the knee-jerk reaction out of it. If you look only at your data, and you see you had a 20% rise in delinquency in 2022, your initial reaction might be our analysts are doing a terrible job. The model's not performing, it's not predicting delinquency. But then you look at the overall industry and say their delinquency raised 30%. Oh, well, we're actually doing a really good job. We're outperforming.
mm.
And so it's taking that more macro approach to be directive on how you manage the business and your own model, rather than being just in the vacuum of your own four walls.
And Nate brings up a good point there about making sure you're looking at other data that's out there. And there's a couple ways you can do it is obviously looking at how the performance is going on in other industries and things. But there's also deals that you declined, and whether you're missing opportunities or you're declining the right deals, we can source data within our database. I know at Equifax to see how did those deals perform. Maybe another lender booked the deal that you turned down,
Mhm.
and seeing if your process is actually picking up on the right metrics and things. Are your declines legitimate, or are they actually performing well in the market? You maybe missed an opportunity. So it's something that's an analysis that can be done to test out your process and make sure it is effective, even in the different economic cycles.
Awesome. Well, great content. Dan, is there any external indicators that you find through your lengthy career that you think should trigger adjustments to your model?
I mean, we've touched on a fair amount of it. I mean, the more and more data is out there. I mean, there's robust reports like a Clear or a LexisNexis that can tell you a lot, but that's fairly granular. You can't do that over your portfolio.
Sure.
You can't do that. There are obviously industry reports like through IBIS World, that if you want to track that kind of stuff, and they'll make predictions and so forth, and again, I think it rolls into, at the very top, talking about, as Nate said, your go-to-market strategy. What is your company? And so you can overlay this stuff over what you're doing, and you can also take the approach of, hey, look, are there markets we're not in? I think that's one of the things that a lot of equipment finance companies are constantly grappling with is, hey, what we've got is working. Everything seems to be rolling pretty well here. Should we get into something else? Because it's inevitable one of these things will turn down. And those kinds of changes can be difficult because it's hard to learn about those
Mhm.
things. What do you know? What do you not know? But I think in general, I always start with my own portfolio. How is that performing? And then you start to look at, for us, it's NAICS code. And are there, do you want to bifurcate it by the full 6-digit NAICS code, or do you go broader and just do the 3-digit? So transportation as a whole, is that too broad? You have to determine how to bifurcate this stuff, because it can be information overload for sure, but I err on the side of more is better. And there's a lot of resources out there that I think everybody's familiar with, but it's just bringing it in and making sure that one, and then the other thing is that you got the proper correlation. You
Mhm.
you got to be wary of the false correlations,
Yeah.
that can happen when you're looking at this stuff.
Yeah, that's probably really difficult. Um, David, Dan talked a little bit about the use of portfolio data. Can you expand on that? Can you take it down a level? Like how do you use that portfolio data to fine tune your model?
Yeah, so I think a really common way is to use a certain delinquency threshold as a proxy for default. So maybe it's like 60 days past due or 90 days past due. And assume that the majority of those deals are going to go bad so that you're able to fine tune your model quicker than actually waiting for actual losses to hit your books. Um, there's lots of reporting that you can do in your loan origination system or through your loan management system to align those with existing originations. So you can see how many trucking deals you put on the book versus what the actual delinquency rate is versus how many are coming off your books at any given time.
Great feedback. I think I think it was Nate that talked about sales breathing down your neck. I think Adam, like one thing that it's a recommendation for PayNet, if you could like create like a correlation chart between the credit analyst popularity rating and during good times and bad, and just maybe the more popular ones are the ones you have to be a little bit wary of, and those least popular credit analysts bring in sales to do all the rating. I think that might be a good correlation as well.
Yeah, no doubt.
All right. So I'm not going to limit the other considerations to just these three that we're seeing, but I would like to have the panelists speak to these or others. So obviously, fraud is a big one that sometimes gets mixed into credit scoring and automation. My guess is syndication, and I use that term broadly. I mean, my guess, Nate and Dan, you guys are probably selling some deals back into the market, kind of getting some more gunpowder into your organizations to do more deals. So there's discounting and securitization considerations as well as you're building out this automation. Um, and then on the reverse side, there's probably like how do you think about like portfolio purchases? Because that's a big portion of strategy, right? Like getting assets under management. A lot of times, our clients will buy portfolios and want to run them through scoring models. So I'm going to kind of leave this a little bit broad. We don't have a data slide on this last essential, but what are your guys' thoughts? Like, what are some do any of these resonate with you? How do you guys think about syndication, portfolio purchases, or other topics?
I'll hit on fraud, the first one right away, because yeah, fraud isn't necessarily part of the scoring model where we spend a lot of our time talking, but it is a huge driver for us on something we're trying to automate more of. And so you have your normal layered in reports you run, whether it be Clear, Lexis, Nexus, Ekata. There's a number of service providers out there that can risk score for fraud. But what we're working on, and what I know Northtech is working on, is a more dynamic application experience that, all right, those scored higher for fraud. Can we present the customer with something else to overcome that fraud barrier themselves before we have to involve human intervention? And when I'm talking about, can you do KBA questions earlier in the process rather than waiting for documents, which is where we currently do it, or driver's license, real ID type verification, that type of thing. Can you dynamically present that to the customer so you don't introduce friction by asking for those little bit more obtrusive things on every transaction, but only when they're necessary? So that is I think that a big shift that we have on our radar for sure.
Yep. And just a quick clarification, KBA, knowledge-based authentication. Basically, what car were you driving back in '95, right? Before
Yeah.
signing the docs.
Out of
So
wallet questions, they call them. Yeah. If
Yeah.
you stole a person's ID, something you wouldn't know just from that.
yeah,
Yeah.
yeah.
As far as on
Dan, I know you.
this,
Oh, please, David.
so on the syndication front, we had a lot of success at a previous lender I worked at, integrating that into the credit process to identify who in the market likes a deal better. So running a scorecard and making sure that we're not double underwriting and have an analyst look at the deal twice, once in-house and once another lender, to get that deal out the door as fast as possible. So there's still a good customer experience. And we're not making more delays by working with an additional lender in the process.
Great. All right. Well, hey, we're down to 4 minutes. I'd like it to open it up to the audience to see if there's any questions from the audience. And just be forewarned, we have pretended like somebody asked us questions if you guys don't come up with your own. So you're not going to get off early by not asking your questions. So we'll hold tight. Okay. Well, I'm gonna go with one of the made up ones. And this is, no one's prepared for this one. So this is off the cuff. So I'd like to hear from Adam. I'd love to hear your perspective from a macro standpoint, and Dan and Nate and David. Like, what's the one macroeconomic trend you're watching right now that you might think could have a significant impact on credit quality over the next, let's call it 2 to 4 years?
I mean,
Yeah, I mean, when I look at delinquency, I mean, it's just so up in the air right now because you're starting to see certain industries kind of separate a little bit. And I think with a lot that's going on with interest rates and the tariffs and things, you just don't know where with the end of the year. So I think that's one of the big things is just really delinquency and how that plays into different portfolios. I've talked to a few lenders out there that are seeing definitely a little bit of stress here in this past quarter as different, and that can change how the front end, especially if you talk about like a 360 feedback loop to the front end, that really changes how people underwrite in different industries. But I think the delinquency metrics is a big one right now. And then the fraud, it would be the other one that I think is and when you think about it from a commercial perspective, it's more business verification, just because it's really hard to pick up on a commercial fraud, with all the aspects to it. But, identifying that business is really important right now before they actually go out and complete that spend on the credit data.
yeah, I think for me and at a lot of ELFA conferences you hear tariffs like it seems like a couple weeks that's all anybody talks about, and they're massive and they're in every country, and then everything slows down and then you don't hear about them, and then all of a sudden they're coming back. I think there's still some uncertainty around it, and quite honestly, trying to understand how they work, and I think a lot of the small business people out there, are trying to figure that out, or is it, is it the products they're selling, the products they're buying, the raw materials, what is going to impact their bottom line, and then how do they respond to that, and should they finance equipment right now? I think there's just continues to be uncertainty until it's not the new normal yet in my mind, other than just talking about them all the time. That's the new normal. But having them truly implement it, or what agreements are in place with what country and on what products and so forth. I think it still sends a lot of uncertainty in the market.
Awesome. We got 1 minute left, and we did get a question came in. So, hey, Kit, good to hear from you. Thank you for adding the question. So here's a question. Delinquencies are a major concern. What are you doing with your client services to help alleviate this issue? We are at 1.75%, 30 plus days in trucking. Any thoughts from anybody on that one? What do you do? Like, what are you doing with your client services to help alleviate the issue?
Yeah, so when you're talking about client services, it's too late to eliminate the delinquency, right? So I think it's framing it that this is where the benchmarking comes in important for me again. 1.75, 30 days in trucking sounds high when you look at it just there, but you look at Adam's chart comparing the trucking industry as a whole, you're not alone. You're not on an island in that performance. And so it's how do you manage that as best as you can to maybe outperform the person next to you in that space a little bit.
Yeah. Well, hey guys, we're at time, and thank you, Nate, for that answer. Thank you all panelists for participating. You guys are all great partners. We're very grateful for you and your time, and also all the participants. Thank you all for putting up with us for an hour, and have a great day.
Thanks, Christian.
Thank you.
Thanks.